So today was Jackson Hole Economic Symposium, right? And this is the day where our friend Jerome Powell finally came out to tell us what he thinks is going to happen next.
Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%.
Remember, one story in the market right now is the fact that I think he's been overdoing it and they're expecting him to lower the rates in order to fight inflation, which does not need to be fought anymore because it's under control. Right, so there's a bunch of people out there on both camps. Are we going to have a recession? Therefore, do it a little bit, or we're not going to have a recession. Then be careful, right? So if we think there's going to be a recession, then start cutting like mad. If you don't think there's going to be a recession, then do a cut and then we're done, right? So this is a story in the market right now. Of course, as usual, we're not really talking about some of the bigger issue having to do with the debt. We're not talking about the issue having to do with global issues like the war in the Middle East, the war in Ukraine. Russia is getting in bed with with China and North Korea because of this war. So, okay, fine. So let's forget about it right now. It doesn't exist. Let's just focus on what he's going to do on September 18th and focus and focus and focus. Hello, folks. Welcome to my channel. This is the Smart Investor. And what we are about is really educating you. I am here to explain to you what's going on. A little bit in my backyard right now to, let's relax a little bit. We're not trying to predict the market. I mean, I don't know what is in this guy's mind, but we want to take advantage of the market. That is what we're trying to do, right? So usually to do that, you want to be there before everyone else, right? You want to buy when everybody else is selling, or you want to be selling when everybody else is buying. Right now, it would appear that everyone is buying. Their mother and them are buying, which is basically pushing the S&P higher and higher and higher. So technically right now, if you're a contrarian and if you think that there's going to be a recession out there and he's going to have to cut like mad and it probably won't matter, then you should be saying sell, sell, sell. Now let's go over the detail a little bit. Let's explain exactly what happened, right? So what did he say today? Today, he basically said that the Fed is likely to begin cutting rates. So, okay, that's going to happen. He's going to cut the rates. You might see a little bit lower borrowing cost. Might be easier to buy a house because the cost of the loan is going to be less. If you're a business, it's going to be easier to borrow money. And the reason he's saying is likely because in his mind, remember in a couple of videos ago, I did say that it was the risk of inflation he was focused on. He didn't care if you lost your job and he didn't care about the recession. But now his mandate is shifting because, inflation is under control, right? I mean, we were at 7%. Now we're down to 2.5%, close to his 2% target. So we can do certain things. There is a possibility. So the risk of inflation is fine, is under control. So now what he's doing is he's focusing, guess what, on you? He's focusing on the risk of the job market because unemployment has risen from 3.7 to 4.3.
Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring.
Not a big deal. It's not 10%, right? It's not 20%. It's manageable. The only thing is you need to know one thing is when unemployment starts to rise, it then rises a lot. Let's see. We're just looking at history here and see what happened historically. Is that the issue? The second thing is if he's able to do a soft landing, which seems to be happening, and bring down inflation, it will be a historic achievement.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market.
Only done once. The Fed, imagine the hammer trying to kill a fly, right? You're going to destroy the table before you kill the fly. The Fed only done it once, I think in 1995. Since then, nope, recession. So let's keep that in mind when we're saying that everybody is buying, so we should be selling. Let's keep that in mind. Because if the people that said that there will be a historic achievement is that unemployment is not going to rise, I find it very, very unlikely, right? So you should be selling right now. I mean, you don't have to sell. You could be, buying puts, whatever it is that you want to do to take advantage, because that's what we're doing, advantage of the situation. No, what is really going on, it doesn't matter what's really going on. Do we really have an inflation right now? You're not going to know until a year later if you were in inflation. The numbers are not going to come out today to tell you, yes, we are. We're just acting, behaving, thinking purely on information that we're given, and it's an estimation, right? We don't really know what's going on. And to make matters worse, like we said yesterday about the claims number, the non-farm payroll, right? The non-farm payroll numbers, they were off by 818,000. So even that number wasn't correct. So what are we really doing here, folks? We're just trying to, trying to get that fly with that huge hammer, really, and try to make some money along the way. So don't try to figure exactly what's happening. What you need to do, you need to understand the players, like I always said, understand what Jerome Powell is thinking. What's in his mind? What is the little mind of his? What is he thinking? Right? He's thinking and he's telling you, so listen, folks, I think we got this inflation under control, but oops, I might be losing employment. Oops, maybe we have a recession. Right? So, or maybe he's saying, we got this under control. I'm going to go into the, what we call the Hall of Fame of central bankers. Like you'll be remembered the way you remember Paul Volcker, or you remember the other guy that lasted 20 years. Okay? So that's what he's aiming for. You, my friends, need to decide where do you stand and what the market is likely going to do once it finds out, I guess, on September 18th. I mean, right now, the market is expecting like 100 basis points, like several cuts, maybe not on the September 18th, but a cut and a cut and a cut. You got to cut because we have a recession. Now, do they truly believe that? Not so sure. But the market's not stupid, right? Understand that player. That player wants lower rates. Why? Where are you going to put your money? You're going to put in a 2% CD? No, you're going to put it back in the stock market. Stock market did great in 2008. It did fantastic in 2008 when the rates were at zero. For good reason. I mean, it was a disastrous time. Let's not go back in that, but right? So understand his motivation. Understand the players. So the players are basically pushing. The market is pushing, is forcing the Fed. Now that means, how does the market pushes and forces? That means if they don't get what they want, expect significant stock market drop. Why? They're gonna say, you see, we have a recession. You see, you're not lowering it fast enough. You see, we're going to get killed because it's very unlikely you're going to achieve a soft landing. It's very unlikely that unemployment start to rise and it's not going to rise a lot. Somebody only did it once, and they pulled it. And you're going to do it? No. Cut the rates now. I want people to stay and invest in the market. You see the thinking? You see what they're all thinking about? I know I was there in 2008. What a disaster. So, as an investor, you are going to need, from me, not so much a recommendation or prediction, but you need the understanding. Now, having said all that, we're going to say, hold on a second, hold on. You're panicking. You're panicking. Why am I panicking? You're panicking because this is not business as usual, right? First of all, we rarely go into a recession when there's nothing really going on. I mean, we went in a recession in 2008. Well, it was obvious. We lost all liquidity. We went in a recession in 2020. Well, COVID. I mean, you need something major. We don't go into a recession because you're raising rates, right? People lost confidence. People don't want to hire. It's horrible. There's a problem, right? So that is not likely to happen most of the time, right? The thing is, this is unusual. This is unusual because the reason he's able to manage this soft landing so far while managing the inflation, good job done, is that we came out of very unusual time of COVID, right? I mean, it's not like we didn't want to make money. We were not allowed to. It's not we didn't want to hire people. We couldn't. You had to stay home, remember? You had to stay home and do nothing. Collect the money from the government that were giving you for free, which obviously created inflation. And we had a supply chain issue at the same time. So now that I think this whole thing is actually unraveling, I mean, supply chain issue is not an issue anymore. And last year, this time was when we had the whole COVID remnants kind of liquidated out of the market. So it's unusual circumstances. Maybe it is not your typical recession driven. It's something else. It's different. So maybe I could put it off. So if you believe that he's able to pull it off, if you believe that he's going to lower rates just enough and still manage with no recession and a soft landing, stay on board, people. Stay on board because the market is going up. Why? Well, I mean, we don't have a recession. You potentially are going, and each time he's going to lower those rates, bam, we're going to explode in higher and higher and higher valuation. Of course, the other issue you need to worry about is that if you lower rates too much, what happens? Well, pricing pressure again. Why? Well, you're lowering the rates. People figure, hey, let me buy some stuff. Let me finance some stuff. Let me get out some stuff. Let me acquire. Let me do a bunch of things. Prices go up. You hire more people, and here comes back inflation. So he's got to be careful what he does. right? And worst, if he does this, right? I mean, he lowers and lowers and lowers and lowers. Meanwhile, this recession that lots of people are predicting is coming behind those trees. It's on its way. It hits you right at the time where you're like being forced now to lower rates. And the inflation is already built in the system because, you lower the rates. I mean, these things takes time. You lower the rates, the market gets excited, rates go up, inflations go up, and then the recession hits, which is probably on its way or not, we'll see. Then you've got stagflation. And of course, since he has lowered rates and lowered and lowered and lowered, he hasn't much more room to go. Because now you're at 2%. How low are you going to lower the rates? Back to zero? You have a stagflation, recession, inflation, and you have not much things to maneuver. Now, this is not happening next month, obviously. This could happen a year from now. And then you still have those boogeymen hanging around. We got the 35 trillion hanging around. We still have a potential war in the Middle East. We're not resolved yet. We have a potential war in Ukraine. Trump hasn't been elected yet to stop it. If he can, that's what he says. So as you could see, the coast is not that clear. Now, of course, you could believe in rational exuberance, like I said yesterday. And say, come on, you're exaggerating. This is going to be fine. He's going to lower the rates 25 basis points. He's already taking care of inflation. This is an unusual situation. This is not like a normal situation. There's not going to be a recession. People are back to work. Supply chains are working. And he's going to focus on employment. That's what he's going to deal with, and he's going to manage unemployment. Because we think he can, then you're back to the races. Buy like mad, because right now, while people are buying, not everyone is buying yet. So start buying. See the dichotomy you're in? So again, you need to make sure is that you are perfectly clear as to what's really happening. So what do we do in our portfolio? Well, in our portfolio is behaving very well, right? Because right now my portfolio is built for growth. I am not built really for a downturn, right? I only have one hedge. I only want one put. Now, I did buy some, and I'll put the detail of those stocks on my Patreon channels, along with a couple of interesting podcasts I did. I interviewed a few interesting people on yesterday and last week on rates and things like that. It could be interesting for you. The point is that we are now in a situation where everything seems to be going up, and my portfolio is built that way. Like I said, I do not have too many hedges. Now, what would change my what would I change my mind, right? Well, frankly, if he doesn't do more than one cut, that means that my small stock portfolio, which tends to behave better when you have multiple cuts, because I want my cake, I need it. I want lower rates. I don't want inflation. Okay? But the way these things hit, they don't hit right away. I mean, he could hit on September 18, boom, lower rates, very easy. But this thing that's groundswell that's coming behind us, or not, if it hits, it's not going to hit now, it's going to hit after he does anything. And even if he does lower rates, it'll be too late. So I hate to tell you folks, we are in it already. Now what you can do, because there is uncertainty, because we don't know exactly where we end up with this deal, is it going to go up? Is it going to go down? Is he going to do this? Is he going to do 3 cuts? Is he going to do 2 cuts? People are talking, they're talking their games. Obviously, what you want to do then is you might want to take a look at some short-dated options so you could play the volatility. Like right now, I would make money through my call, but should it go around, psh, it goes down, but I make money on my put. And then I unwind. Not at the same time, obviously, because if one is making money, who's going to lose? But if it does this, thank you, and I'm gone. You could do that. At the end of the day, what you really want to do is you want to make sure you know what you're buying. Because at the end of the day, even if you have some kind of slowdown or some kind of recession, yeah, your stock is going to get hit. I don't disagree, right? But at least you're owning companies that have growth potential, that kind of, and obviously if you have 500-600% built into your gain, it behooves you maybe to line up a little bit just in case we have a recession on its way and he doesn't end up in the Hall of Fame, because that's where he wants to be. I would remind you that the chairman, Paul Volcker, in the 70s squeezed and squeezed and squeezed the economy by raising and raising and raising and raising the rates, and like that. Raised the rates, got us into 20% unemployment, high rates, recession, disaster. But he tamed inflation, right? The second chairman, right? The chairman that was responsible for the 2008 crisis, well, not responsible, but he kind of encouraged it. While in 2000, what he managed to pull it off in 1995, by avoiding a recession, by by lowering rates at the same time, getting inflation under control without any recession, he got killed with the in 2008 when the whole thing hit. What, things went bad, and he got fired. Well, he resigned or whatever. But he wants to be in that company of these two people. We shall see. But what you need to watch out for is how to position yourself. Understand the player. Be very mindful. Be very mindful if you don't get to see the portfolio whomever is recommending. You could be talking NVIDIA all day. Do this, retire with that, 1,000, 3,000. That's just talk. What do you have? What have you done? What is your performance? Okay. Again, I'm here to educate you. I'm here to try for you to take advantage of the market by understanding the players. If you understand the players, then you understand the market. And it's important, because how do you make money in the stock market? Well, how do you make money anywhere? Right? You gotta, what's great about the stock market is that the market works for you. The market works for you. The market makes money for you. That's a beautiful thing. So keep that in mind going forward. Keep that in mind, and I will see you this weekend. Let's do a wrap up for the weekend tomorrow.